Imagine waking up tomorrow morning to breaking news. Charles Schwab, Fidelity, or Vanguard has suddenly filed for bankruptcy. Combined, these three institutions hold over $26 trillion in wealth. That is more than the entire GDP of the United States. You open your phone on a normal Tuesday afternoon, tap on your investment app, and your retirement, your index funds, and your entire life savings read zero. Does that money evaporate into thin air, or is there a hidden mechanism working behind the scenes to protect your assets? Assuming these giant firms are simply too big to fail ignores the reality of how fast financial disasters strike. Look at this model. Most of us picture our broker taking our cash and locking it inside a physical, personalized vault. That is how a bank operates, but a brokerage functions more like a magnifying glass, simply observing assets held in a central depository. This is the legal concept of custody. Your brokerage is just a secure digital access point. They do not own your shares of Apple or Tesla. Those assets belong entirely to you, separated by a rigid legal wall from the broker's own corporate money. If the executives at Schwab or Fidelity make terrible bets and bankrupt the company, the creditors pounding on their door cannot legally cross that wall to seize your investments. Recognizing this legal barrier is your first and most effective defense against making an emotional, panic-driven decision when the headlines turn terrifying. So what actually happens on day one of a failure? Regulators immediately step in, freeze the platform, and begin transferring your exact portfolio over to a healthy competitor. But there is always the fear that during the chaos of that transition, some of your shares might go missing due to accounting errors or outright corporate fraud. This is exactly why the Securities Investor Protection Corporation, or SIPC, exists. It provides a safety net specifically to replace those missing assets, covering up to $500,000 per customer. Since the agency was created, 99% of eligible customers caught in brokerage failures have successfully recovered their assets. But notice what SIPC does not cover. If the broader stock market crashes concurrently with your broker going under, this insurance offers absolutely zero protection against your portfolio losing value. While your shares are insulated from the broker's bankruptcy, you are completely helpless to sell them if the market starts bleeding while your account is locked during the transfer process. This chart illustrates the cash trap. While SIPC covers up to $500,000 total, uninvested cash hits a hard ceiling at $250,000. Any money sitting uninvested above that mark could be wiped out the moment the brokerage fails. Vanguard, however, operates under a completely different set of rules than publicly traded companies like Schwab. Vanguard is owned by its own funds. If you hold a Vanguard mutual fund, you are literally a part owner of the corporate entity. Because the company's operating capital comes directly from the funds it manages, a total corporate collapse would essentially require a broad, permanent liquidation of the U.S. stock market. Even with legal protections firmly in place, the psychological chaos of widespread fear poses the most immediate risk to your wealth. When millions of users simultaneously attempt to withdraw cash, sell positions, and transfer accounts, server networks overload and trading platforms crash. We have seen this exact dynamic play out in physical bank runs over the last century, where a sudden loss of public trust triggers a catastrophic liquidity crisis. The sudden implosion of Lehman Brothers in 2008 and the rapid collapse of regional banks recently prove how quickly investor confidence can evaporate. In every financial shock, the reactionary panic of the herd consistently destroys far more individual wealth than the initial market trigger. To prevent that from happening to you, there is a 3-step action plan you can execute today to bulletproof your portfolio. First, never hold excess uninvested cash in a brokerage account. Move it into a high-yield savings account that is backed by actual FDIC depositor insurance. Second, once your total portfolio crosses the $500,000 SIPC threshold, structurally divide your assets across 2 different megabrokers. Third, turn on 2-factor authentication immediately. Statistically, a hacker stealing your password is a much larger threat to your money than Charles Schwab going bankrupt. Maintaining strict rationality during moments of extreme fear is how wealth survives generations. If you want to stay prepared, subscribe to the channel and let me know in the comments, do you trust the system holding your money, or is it more fragile than we think?